Get ready to peer behind the curtain of the private equity universe with each episode of Best But Never Final. Hi, I'm Lloyd Metz, joined by Doug McCormick and Sean Mooney. Together, we'll navigate the corridors of private equity, revealing the uncommon knowledge, challenges, successes, and lessons that drive the world of private equity and business forward. Let's go.
It is great to be back with Lloyd and Doug. Doug and Lloyd, how are you guys?
Good. Hey, Sean. Hey, Doug.
Good to see everybody this Friday. We made it.
So I think this is going to be a really fun one. We've done something like this episode last year around the same time. And so when we're recording this to place this for everyone is right around the end of the year. And this is a great time where we can kind of reflect on the year that was, think about kind of the things that we're thankful for, things that are happening in the year, particularly through the lens of folks like Doug and Lloyd, who are in the world of PE, which is very dynamic, but also just the world of just being humans. And then we're going to dare to look into the future and give some predictions into 2025. Does that sound like a good plan?
Bold agenda. Bold.
That's awfully profound and deep, but okay, let's go.
Every once in a while, we dare to look inside our minds and get quiet. So let's hit it. So, Lloyd, we're going to throw you the hot potato first.
Uh-oh.
What was your take on 2024? Simple question.
Yeah, right. Super simple. Honestly, it was, on balance, a good year and a balanced year, I think. When you think about not just private equity, the broader capital markets, debt and equity, the broader economy, it was actually a pretty good year. And it reminds me of a Peloton instructor, for all you Peloton fans out there, said the other day, the problem is not that it's hard. The problem is that you want it to be easy. And I feel like that's how a lot of people in our business view 2024. It was a slog. It was a grind. And that's not to say it wasn't, but who's to say it was supposed to be easy, right? I think maybe folks got a little spoiled by some previous years where it was a lot easier to get deals done or to raise money or to do whatever they're trying to do.
I think that's very well said. How about you, Doug?
First of all, I think it was in some ways the year that never happened. If you went back to this a year ago, we had a bunch of bankers on the calls on our podcast, and they all said the markets are going to open up and it's going to be a really robust kind of M&A environment. And I think it got better, but it certainly didn't hit the go-go days. So maybe that's ahead for us in 2025 when we talk about predictions. And I think that the two things I would observe on the year, for us at least, was one, I do think there's this divergence between the markets and the economy. And Lloyd kind of mentioned it, I think from an economy perspective, kind of a slog. Inflation still challenging, labor markets challenging, the consumer leveraged. And so I think those things make it hard to execute the business. And you think about the markets and they've been roaring. And so I think that's just an interesting dynamic. You think about the macro of what the Fed's doing and the interest rate expectations and how that influences the market versus the lag in seeing that stimulus in the economy. And then I think the word for the year for private equity shops like Lloyd and mine, and also for HCI in particular, was liquidity, DPI. And so we focused a lot on exiting a couple deals. So we got two things done. We have two things that are either in market or about ready to go to market. And so big focus on the asset class in terms of trying to return capital to investors.
Yeah, I think that last part is super important. There was a lot of attention put on generating liquidity for your investors. And depending on your industry, depending on your particular asset, the market was favorable and sometimes not as favorable as you would like it to be. So it could be a bit of a challenge at times as to whether you think, all right, let's go through with this liquidity event, even though perhaps we could get a little bit more or meaningfully more if we held on to it a little bit longer. I'm sure, Doug, you all at HCI, just like we were, wrestled with that throughout 2024, debating that throughout 2024.
Yeah, and I think that as the M&A markets remain somewhat tepid, the pressure continues to build, both on the GP side of delivering liquidity and then from the investor side desiring and having an expectation of getting liquidity. So I think that general pressure continues to build. The fact that the markets are up probably helps in the context of asset allocation, but liquidity is still at a real premium.
Yeah. And Sean, I imagine this is good for you that there's a lot of exit preparation on the part of private equity firms taking place today, right now, this month into January. And that's good for you, right?
If you think about us as a 2-cylinder engine, right? We support PE firms and portcos on value creation. That's been off the charts, right? Because you all have to transform these companies always. But when the economy's wishy-washy, then you got to do even more. But the new deal part of our business, like the support, the execution, the diligence resources, just been really, really quiet over the last couple of years. But that's now really starting to come back. And so we're like, I wonder what it's going to be like to have a 2-cylinder engine where they're both firing at the same time. And it's interesting just reflecting on what both of y'all had said is that in some ways this year, like we were talking internally, like this year's like, this has just been a slog, as you said. It's like I felt like I was in a washing machine with like good news, bad news, good news, bad news. I'm like, can we just get like 2 or 3 good newses going in the right direction before we cycle into bad news? I don't know if that resonates anything. But then one of the books we give out to each one of our team members is actually a children's book. And I started thinking about this because we're just doing our year in review kind of strategic planning. And it's this book called The Boy, the Mole, the Fox, and the Horse. And it's written by this illustrator from Great Britain. And there's this great little section on here where they're going through this kind of tumultuous stretch of the book and their lives. The boy's like, this is like, look how far we have to go. It's like so far to go. And then the wise horse goes, yeah, but look how far we've already come. And so we looked at this year like through that lens because we were like, the whole session was like, what can we do better? What are all these things that we didn't live up to? What are all this stuff? And then we just started writing on paper, like, here's all the good stuff that happened. And we needed like 2 pages. Like, let's get a little perspective here. There was a lot of good stuff that happened this year. Deloitte named us to the top 500 most innovative, fastest growing tech companies in the country. And then we added all these people and skills, and our AI engines are doing better than they've ever done before, probably at the leading in their class. We did all these different things. We did a NetSuite implementation, which I now have a whole new kind of appreciation for being on the other side of one. And so all of that stuff, I was like, you know what? It's pretty good. And then we'll talk about this later. It's like, I think we're teed up for a really good next year.
It's, I think, one of the natures of being in a management position. I always focus on the problems because the good things seem to take care of themselves. And so you end up getting a skewed perspective. So we just did our annual meeting and we did it in mid-November. And it was interesting because it's a great forcing function to kind of like assess how your organization is doing, where you're excelling, where you're struggling, and really kind of pick your head up and evaluate where the market is. And I think one of the things that's fascinating to me right now is I think the public markets seem to be all up and to the right in terms of like appreciating and the markets acting in unison. But there are so many disparate parts of the economy that are behaving very differently right now. And so like, I think it's a little bit flawed to talk about like, is the economy good or the deal market good? It's more like what's happening with healthcare, what's happening with technology, what's happening with consumer, what's happening with industrial. They're behaving very differently in what I'll call a transition economy.
It's spot on. We'll talk about this in a little bit, but I do think we've gone through an economic cycle that most people didn't really know we were in an economic cycle. I was curious earlier this year, and so I was like, it doesn't feel like the economy at large is in this kind of like 3% growth phase or 2% or even 1%. And when I pulled apart GDP, it became really clear like business services was doing well, but industrial was 100% in a recession for the last 18 months. And tech was in certain places and healthcare services was. But when you start pulling it apart and putting it back together, you start saying like they're all kind of coming out of it and have been coming out of it and are starting to like hit their stride. But it's just like you said, like in total, it's like you get so many mixed signals. I found it really hard, probably one of the hardest years ever to really get the signal from the noise.
I agree with that. Are there any particular areas that you were able to see, Doug, from your portfolio that kind of surprised you?
We have a lot of exposure to food. that continues to be very steady, but 1 to 2 times GDP growth, driven by the convenience factor, the dual income families, busy lives, and everybody eating out. And I think I've seen more softness in that than I would have expected, which I think translates into the consumer being stressed and leveraged. But like that's a real steadfast demand profile that is showing a little bit of fatigue.
Yeah, we're seeing something similar in the food parts of our portfolio, a slowdown. So not as rapid growth as we saw in the beginning of the year. The growth rate's now tapering down to low single digits. So there's something going on with the consumer for sure.
And let's face it, like low single digit end market growth is still pretty solid if you've got a small asset that you can do things with to grow faster than market. But if you just looked at that profile over a 20-year period, I think there's been over a 25-year period, there may have been 1 or 2 years where it's negative. And when it was negative to like 1%. And so it's just surprising how steady it is over many, many years. And I think it's still positive, but seems to be a little bit slower than normal.
This episode is brought to you by HCI Equity Partners, a lower middle market private equity firm focused on partnering with family and founder-owned manufacturing, service, and distribution companies. ICV Partners, an innovative private equity firm supporting management teams of leading companies at the lower end of the middle market. And Blue Wave, the business builders network, connecting the most proactive business builders in the world with the best of the best service providers for critical, variable, on-point, and on-time due diligence and value creation needs. Now, back to the episode.
For both of you, where are you seeing kind of the green shoots coming up, the positives that kind of give you some of the flip side of the coin, the positives that might be happening?
Some areas that we're really excited about looking forward are some of the food areas that involve some niche products or niche product applications and the ingredients that go into those niche product applications. We're pretty excited about that. In business services, we're really interested and excited about infrastructure services. So the maintenance of everything infrastructure related, bridges, tunnels, towers, wires, utility plants, everything that you can think of. We think that still offers some pretty interesting opportunities. So we're pretty excited about that. And there's a couple of other areas that we're really keen to find opportunities next year and the year after that, to be honest.
2 broad themes. First of all, I agree with your assessment, Sean, that industrial has been in some kind of contractionary environment. So I think we see that to be an interesting cyclical play. You overlay that with change in policy around minimizing regulation and pro fossil fuel energy. And I think that's going to be a big lift. So I think that's a really kind of interesting part of the market. We generally try to base our thesis more around our ability to run a consolidation play in a really stable market than trying to underwrite the market per se. And so most of the industries that you hear us talk about, they're technical services, they're things like food and market exposure, where that's not going to be determinative in like, did we pick the cycle? Because we're really trying to pick the consolidation play in a relatively stable business and drive the alpha more by the activities as opposed to calling the end market rate.
That makes sense. Maybe one thing on this year that I'd be curious to dig down further is if you think about all the things that have happened this year, right? You had a pretty contentious geopolitical situation. You had a major election economic cycle. You had multiple assassination attempts on a presidential candidate. So there's a lot of noise. And you're pointing out there's also but a lot of good things happening. And one of the things that I think is not lost on a lot of people is talking about some of the things in the debt markets, where the debt markets seem to have really come back this year in terms of not only with now declining interest rates from the Fed, which tend to price more at like a spot rate than the housing market, which is a 10-year treasury, but also the spreads. I think we talked about like it was SOFR 700s or 800s at the beginning of this year. Now it's like 300s. And so as you think about its impact on this year and then going into next year, how has that really impacted you all in your ability to kind of either bridge valuation gaps or just get things done or return capital?
I think it's been dramatically helpful in terms of being able to get stuff done. I don't think it's cheap financing yet. So I don't think it's like, hey, it helped us close the valuation gap. But I think you have a confidence and ability to transact based on reasonable leverage levels at reasonable real cost of capital adjusted for inflation. I think it's at a minimum stable and probably on the healthy side with an expectation it's going to continue to get better.
Yeah. And I know we're going to talk about the future, but I wrestle with that because when you look at some of the fundamentals, you talk to a bunch of different economists, and economists have all kinds of points of view. So you have to take it with a grain of salt and develop your own point of view. But rates have come down, obviously, but the broader credit markets, treasury markets are suggesting that there is a meaningful chance that the rates could be higher in 2025. Spreads are attractive. So we're trying to take advantage of that and refinancing and several of our portfolio companies over the next 2 to 3 to 4 months. I'm not sure that the decline in interest rates is going to continue in the short term like people think. And even if it does, I'm not sure it'll be enough to bridge, as you put it, Sean, the valuation gap between buyer and seller. So owners of assets need to make hard choices if it's not your premium A+ class asset. You're just going to have to make some hard decisions. And then how do you factor in, or how do you think about a potential increase in interest rates at this time next year or early 2026? That's what I'm wrestling with.
Yeah, I think you're right in that this isn't something that's going to be like a capital structure fix between the bid-ask gap that exists. We're looking at our data, right? The data that we get is really pretty cool in that we're able to see in large numbers what PE firms are doing. And then you put them in the buckets and you look at the trends over time. It kind of tells the story of economic action. In the third quarter of last year, we saw growth strategy activity up year over year by 80%. And then sales and marketing operational improvement activity up by more than 20% year over year. And so what's the one way to bridge the gap? You grow your way out of it.
Yep.
And the easy fixes aren't there. And kind of going to the original conversation is like, did you expect it to be easy? No. And but
Right.
So like, what are you going to do?
That's the problem, right?
Are you going to cry and just like wait for the debt markets to go crazy again? Like, no. What y'all are doing is like, no, let's just dust off our pants and let our tears dry. And let's just grow our way out of this thing. Like, toughen up.
He said toughen up.
Welcome to my childhood. No.
I can't argue with anything that you said there, Sean.
These things take time. There's no magic button. Sometimes you just got to toughen up. And I think that's what I hear and see from you all the time. It's just like, here's a problem. We can curl up or we could just do something about it. Let's do something about it. With the toughen up in mind, we'll soften up here. This is also the time of year that we've talked about before. It's like, it either can be really busy for folks like you, Doug, and Lloyd. It can also be maybe a little quieter if there's not a deal or multiple deals that are closing in December. And maybe this year there's not that kind of really intense pressure to get things done by year end because there's not like a cliff or a reason to do so. If you do have some time to kind of take a breath as you round out in the month of December in the world of PE, what do you all do during these periods of time as you kind of like finish up and round up? And then maybe what we'll do is talk a little bit about like a year in review. What are we all kind of thankful for?
That's a good setup, Sean. I got to confess, I generally fail at December's, getting December right. They wind up being way busier than I expected, more travel than I expected. I shake my head. I don't know what I'm doing wrong. This December is travel the first 3 weeks and trying to squeeze in this weekend, getting a Christmas tree. And year in reviews, writing them, and then compiling them, delivering them. We do take that seriously, the process, the feedback. You also start thinking about ways to make the next year, the upcoming year, better, right? You reflect on things, processes, practices, whatever it is, and like, next year, let's not do that, or let's do it differently. It's not quite as reflective as I'd like it to be until you get in between Christmas and New Year's. that's when you're usually, I find I'm able to take some time and reflect.
Yes, that one magical week, 1 week to kind of reset your humanity.
I try to work that in on a daily and weekly basis and not let it all pile up to the end. But no, I get your point completely.
It's always interesting. Usually across the firm somewhere, you're going to have a deal that's going to run into the year-end crunch. We have one financing that probably closes by year-end. That will be a push to keep a couple members of the team busy. We had been pretty heavily engaged in a new deal. It was an add-on acquisition for one of our businesses, sizable deal for us. Did a lot of work and found out we were kind of the bridesmaid. So that was bittersweet because I really liked the asset. I don't think I liked it at the price it ultimately cleared at, but we did a lot of work for it. And I certainly didn't like the fact that somebody else in my industry saw value where I couldn't. I think I'm in the little bit of the sprint category like Lloyd, and the sprint is not only professional, but some personal. So Army Navy game coming up next week. That's a big annual event for me and my extended family. And then I think it's like year-end management stuff. And I think that's not just internal, but external. So in the month of December, we have a number of portfolio companies that are still doing board meetings. We try to be pretty disciplined about CEO evals the same way we do internal evals. So you've got that evaluation process happen, and then you've got the internal evaluation process happen, and firm Christmas party. So that's busy. For me, it's post-Christmas, between Christmas and New Year's, or into the first couple weeks, where I try to really kind of level set and be a little bit more introspective, I think.
That resonates on a couple levels. And I was talking with some of our team as we're trying to do like year-end check-ins with clients and those type of things. And they go, well, what happens in December? And I kind of shared exactly that. It's like they're either going to be really busy because they're closing a deal. There's always really busy. And then everyone gets that 1 week off between Christmas and New Year's. Most people in PE will kind of know at least what their bonus is. And you've kind of like re-energized because you're not used to like a week of just like being able to do nothing. And then everyone puts on their armor and storms the battlefield in January, and no one's on it because there's no deals in the market in January. Like, why is there no deals in the market? It's like, because the number one thing to take a deal to market is you need to know what your December numbers are. Otherwise, you're going to like have your ankle sawed off if you miss it. And so it's not like there's like the best time to get meetings with people in private equity is in January because like, they're all like re-energized. They want to be busy. They want to take action. And there's just no new deal stuff to do yet. Is that true, or where am I on, or where am I off?
But even still, just today, there's a company that we are highly confident is going to be ready for sale. I don't know, February, March, April, something like that. We need to start doing our internal work, our prep work for when it does come. We'll be ready to run after it and be credible and be effective, trying to convince that family or that founder that we should be their partner. So that work starts today.
Yeah.
Go down that path a little bit. How do you have visibility to that? Is there a banker involved, or this is a relationship that you've been building for a while in an area you guys got some competency?
So it's in an area where we have done some white papers, right? Done some industry research at kind of like a high level. We have some LPs that have some perspective on the space. We have a portfolio company that has a perspective on the space. So just making sure we get all the information that we have at our disposal lined up, talk about it, tee it up, line it up so that when that company does come out to market, I imagine they're going to have a banker that we can get in front of it. Instead of waiting and then you're trying to play catch up, we're going to try to get ahead of it. And that happens in December into January.
Hey, that's awesome. That all that hard work, it's like you said, it's like the hard stuff that you expect it to be easy. No, it's the hard stuff that makes the magic happen, if you will. And then this is also a time of year, I think, Doug, in terms of like pulling back the curtain, where there's a lot of these discussions where you think you're going to have the deal and you're coming down, it's coming right to this end, you're down to the final two. And then sometimes there's just only so far you can go. And for me, my psychology, and when I was in your shoes on those, was if we won, we had an angle. If we lost, the other group is crazy.
I have one of those personalities where there's no such thing as like victory. When you win, I have buyer's remorse. When I lose, I feel like I should have won. And so I'm always conflicted.
That's the nature of investing, Sean, right? Everyone's like, that multiple's too high, or what are they thinking? And then next thing you know, it's 2, 3, 4x, and you look like a genius or an idiot, right?
And when you lose, you always were the cover bid. And so, as our banker friends will tell you.
Really?
Yeah. And when we won, I was like, oh my God, we just won a Harris Williams auction. Like 200 other P firms. I was like, this deck's going to be 125 pages now.
You talk about like coming into the new year with a big head of steam. I totally see that in myself and a lot of my team members. And then you throw on the personal stuff too. So I'm a classic, come up with a bunch of New Year's resolutions and fail most of them. But I still think it's a process that's well played because I'll fail, but it's because I set ridiculously outrageous things to go do anyway. So it's a great time to personally re-energize too.
Do you have any big resolutions that you're looking towards already this year? Or is that still in formation?
Still in formation. And if I gave you any of them, it would give you insights into the neuroses that you're dealing with here. So I'll leave that one alone.
Hey, question for you, Doug. Do you ever look back at the resolutions that you set for the year that you didn't hit? And do you bring them back in the next year, or do you just let them go?
Sometimes, yeah. I'm a big believer in like if you publish stuff, then you're accountable to it. So we have a lot of like camaraderie in the office. I try to get everybody to come up with their New Year's resolutions, and that creates some good fodder.
Lloyd, are you a resolutions guy?
Not a big one. Every once in a while, I'll pick 1, 2, or 3 things and then just keep working at it. So right now, I'm actually negotiating with myself on something. First of all, you're not supposed to negotiate with yourself, right? It's just, you shouldn't do that. But I am. Yeah, I just need to get the resolve.
I think you're going to win, Lloyd. You're going to win that negotiation.
I think I'm going to win.
Sean, one of my New Year's resolutions is to be more like Lloyd.
You got to dare to dream. That's a hard one.
Okay, that's hilarious. Do better, Doug. Do better.
Yeah. I always try to set the bar really low in terms of like at least my family's expectations of me. And then I just overcome. But professionally, it's always like you can never be better. With that in mind, are there any things as you start and dare to reflect this year that you're particularly kind of thankful for as you kind of enter this moment of pause?
I continue to be reminded how no day's promised. And so I'm 55, and so I have peers and friends that are in their 60s, and I've seen a lot of folks who had a very normal life one day and a major health issue a day or two later. And so I think I'm just thankful for the health, thankful for like family health.
Yeah, I couldn't agree more with that, Doug. And so grateful for the health, grateful for the family, both my immediate family and extended family, and even grateful for what I'll call my elders, right? The aunts and uncles, some of which transitioned this year, but grateful for their lives and the sharings and the stories that they shared along the way through the years. Grateful for that for sure. Very much so. It's very present, top of mind for me. My aunts and uncles, both present and past.
It's a good thing to do. It's interesting. So I'm much younger than you guys. No, I'm just kidding. I'll be 50 this year. I'll be crossing the chasm into the 5s. And I was talking with my brother-in-law, he was an orthopedic surgeon. And he asked me, he's like, do you have any hobbies? No, I don't have any hobbies. I just work and I have family. And that's it. He's like, you need to get a hobby. Because he's talking about even what I think both of you are sharing. He's like, every day I see people like you who are these hard chargers. And then you get to this point where you always think you're going to do the thing you said you would do. And then suddenly, like, you blow out your ACL, and then you're never going to learn how to play golf, or you're never going to hike a mountain. And so it's like, you just got to get on with living. And so I'm feeling intense pressure right now because this is a conversation 6 months ago. And he said, 6 months from now, I'm going to call you and ask you what your hobby is. And I'm like, oh. But it does cause you to appreciate, you got to live in the moment and appreciate those you love and your friends and your family.
Lloyd and we can help you find some cool hobbies. So like, what's on the list?
I don't know. So that's a problem. I'm not a good human being in terms of like the leisure world.
You're outside of Nashville.
Do you know how to play guitar, Sean?
No.
That's got to be your hobby. Come on.
Well, I always did want to have a Taylor Swift cover band. And so maybe I think that might be, I'll do that, just getting a little more rasp in my voice. And I get some of these studio musicians are incredibly talented. And The auto-tune. I think I can do that. So,
Good thing we're going to have to take Sean offline and help him out here.
all right. I need help. I need to have something.
Spending time with friends and family, I think, is important to recharge. We just came out of our CEO retreat that we have every year, and there's a lot of conversation around self-care and wellness. And it does tie directly to business. It does tie directly to leadership, judgment, right? Decision-making, just having some balance, emotional balance, intellectual health. Like all of those things are intertwined and are pretty important. And to your point, Sean, it's very easy in business generally, in some lines of business and some types of personalities to get imbalanced. And that's not good. Not only for that individual, but for the people who work for that individual, their families, et cetera.
I'm curious just to kind of probe a little bit on your CEO Summit concept. So tell us a little bit about like what kind of tools you're trying to bring to them. There's a camaraderie element to it, so they see the rest of the portfolio, they can collaborate. What are the things you're focused on with those guys?
Every year is a theme, and this year was best in class execution. It's talking about where do I begin? So how CEOs can generate alpha, right? So bringing that concept that's in the investment world of alpha versus, right, beta, which is basically the market generated return, improvement, growth, however you want to characterize it in a corporate context. CEOs and good ones can generate alpha. So your company performs better than the rest of the companies in your group. How do you do that? And what drives that? My colleagues who put this on set it up nicely in the beginning where they had a bunch of quotes. And one was from Picasso, who says that you need basically to have a plan in order to be great. And then the last quote in the story arc is Peter Drucker. And Peter Drucker basically says that strategy is a commodity. So the idea is the strategy, that's the commodity. Execution is an art. So the artist says you need a plan, and the management guru says you need to be part artist in order to get this all right. So again, trying to help the CEOs think about the soft skills, people skills, leadership skills, decision-making, as well as the harder execution skills. So cybersecurity, we had a little section on that. But the key part is to have the CEOs share their experiences and get to know each other better and to view each other as a resource. We had some workshops to talk about different functions that they're responsible for, like innovation, product innovation, service line innovation. How do you drive and think about innovation at your company? And what can you learn from other companies and other industries that might be useful for yours? So it's those kind of conversations. It takes about 2 days. We had some economists, geopolitical types, give their point of view on what to expect in the upcoming year. So again, trying to give our CEO some food for thought, and you don't know exactly how it will translate into anything specific in terms of improvement in performance, but trying to invest in them and invest in their development.
My sense is a lot of the value creation is the collaboration that happens after. You've created that connectivity amongst the CEOs. I've noticed a lot of times the CEOs, they feel out there by themselves, right? And so get them into a group that's dealing with the same ownership dynamics, the same ownership PE firm, I think is really helpful.
The part that I think was pretty neat that they really got excited about, we had a kind of a fireside chat or more reflections from one of the CEOs that led a business that we had an exit this year. And so he gave some of his reflections from his time with us as his partner from the beginnings to the exit, and gave advice to the other CEOs about things to do, things not to do, things he had wished he had done differently or sooner or better. It was really good for them to hear from their former peer. And some of the CEOs in the audience knew the CEO who was speaking from last year and prior years' gatherings. That I think was really cool.
I think those are great evolutions in the industry where you have almost like these expert networks built into your portfolios, and everyone doesn't have to recreate the wheels. I'll get at times invited to speak at these forums of our clients because we just see so much on like the alpha versus beta thing. And I did one recently, and then I realized that since we're not back yet, but I was like, I find myself like, oh, can I be part of your club? And so literally right after this recording, I'm having a conversation with one of the CEOs from their group because like, can I talk to you about how you're doing? They're doing some really cool AI stuff. And I was like, can I break into your club a little bit and like just be with you guys and play in your selling circle? I think there's tremendous value to those, and particularly for CEOs where it is lonely. And then to have that power of your entire ecosystem, like of these A players, is a huge benefit. As we kind of round out the conversation here, let's dare to look forward. And maybe we can just kind of do some round robins here around predictions for next year. And so in terms of what you think is going to happen as you kind of try to predict the future. Lloyd, what's one of the themes that you're kind of seeing maybe probably will happen?
I'm less focused on what will happen in 2025. I'm trying to think more about what may or may not happen. And if it does happen, is that good or bad? How good, how bad, right? And so one of the things I'm kind of stuck on is what if inflation ticks back up in a meaningful way in 2025? And or what if interest rates, base rates, so for treasuries, whatever, tick back up in 2025? How bad is that? Who benefits from that? Are there particular industries or functions or industry segments that would benefit or be hurt by that? That's what I'm wrestling with now as I'm trying to figure out an approach there, because that is a concern, because I don't think that's the consensus view. I don't think that's a consensus view of lower middle market CEOs. I think most folks are expecting inflation to moderate down back to 2% and 1% and interest rates to keep coming down with Fed cuts. So if that's what they're sort of expecting and planning, how big of a problem would it be if they go up both inflation back into the 3s to touch 4 or what have you, and interest rates go back up 75 basis points or something like that?
I'm hearing lots of conversation and debate about the rate of contracting inflation and the rate of interest rate reductions. I'm not hearing lots of, hey, inflation is going back up. So I'm curious, like I understand the negative implications of that. Why do you think that's a high probability thing that you're focused on or worried about?
And that's the thing. I don't think it's a high probability. I think it's in the spirit of almost like Byron Ween's 10 surprises. I can't put a probability on it, but it feels like it is materially greater than the expectation currently in people's heads and in the market and their current planning. So it's how bad could it be, or just the unexpected view? Yeah, this is definitely one of the times where you miss Byron Ween, because he usually would put his 10 surprises out in the first half of December. But trying to apply some of that thinking so that at least at our portfolio companies, we can have them consider it and start making preparations in case it does come to pass and they're not caught completely by surprise and flat-footed.
What you put your finger on is like the one thing that I'm really wrestling with as I try to look forward in the next year. Because I think current course and direction we have been entering and will continue to enter into, I think, the next 5 to 6 year upcycle and an economic cycle. And more of like a 5 to 6 year cycle, not the 15-year mega crazy one we went through. And the big one that I'm having the hardest time wrestling with is kind of at least the posturing around tariffs. And the chain of logic that I'm trying to work through in my brain is, okay, we raise at least on the table 20 to 60% global tariffs. That has to have a meaningful inflationary effect. You have a meaningful inflationary effect, you can't lower the rates. If you can't lower the rates, then we're going to economically stall. And then we go into stagflation.
Yep.
But there's strategic value to reshoring our supply chain. And there may be some people in the powers that be that say, you know what? We're going to take our lumps because we need to bring manufacturing back to the U.S. And there's strategic 50-year value to that. I've had a really hard time like trying to discern the chessboard with that. So I don't know if either of you have kind of thought through that. It's the tariff meets inflation meets impact on rates meets that could stall the recovery that's underway.
And I don't disagree with that scenario. That is one of, I think, maybe several scenarios that just talks about sort of how you get there. But you might be able to make a case that there's a inflation acceleration risk even without tariffs currently in place. So
I think it's going to be interesting to watch how tariffs plays out. I think it is a tool to redefine trade relationships more than it is necessarily a tool to equalize cost of goods. I think it's a threat that can be used very tactically to get concessions on a variety of things. So I think it's a big question mark and a big risk. But I think if you look at like some of the things that have been announced in terms of like the plan, it's as much related to border control and flow of fentanyl as it is certain trade practices. So big question mark though, I think. But also I think Trump's commitment to defending the dollar should make the dollar more attractive and in some ways be a depressant on interest rates. So I think that's going to be an interesting one. In terms of things that I think are going to be interesting to watch, I think we're on the front end of an EV correction. So as you think about like the challenge of electric vehicles, the valuations of those, what that's going to look like in a government environment that is less supportive of subsidy and supportive of infrastructure, going to be interesting to play out. On the flip side, I'm fascinated by crypto. And I'm not like a fan that I think it's $100,000 here recently. So amazing to watch that run and see how it sustains itself.
And what do you mean on the EV world? Can you expand on that? How do you see that playing out?
As I think about the Teslas of the world, how you think about value, how you think about economics, how you think about addressable market size, to me, I think that that's certainly like in the path of progress and a way of the future, but it's not at all clear to me that the market is as big as the valuations would suggest relative to desire for combustion engines, total cost on an unsubsidized basis. So I think those business models have some turmoil to work through as you think about like true cost, true economic value, true customer demand. The market's been distorted by regulation and subsidy that I think is likely the pendulum will go back the other way for a while.
Specifically as it relates to EV, and just asking for a friend here. A friend of mine bought a Rivian R1S. How underwater is he on that purchase? just curious for a friend.
Yeah, I'm not sure Doug's talking about the actual purchase.
No, but I can see how it rolls out. It just all rolls out. Like I'm a little worried about it. I think my friend's gonna be owning this car for a long time.
But Doug, to your EV point, we made an investment recently this year in a chain of lube shops, car oil change and lube shops. So we are on that same thesis with you, Doug.
We purchased a business a year and a half ago that's automotive aftermarket parts. And so it does all kinds of parts and accessories, some unrelated to the engine, but the parts complexity of a combustion engine is way more than EV. And so as you think about like the demand profile for that product, it's a little bit of a contrarian play, at least it was 2 years ago when we made the investment. But our view was when you look at the install base and you think about like what the addressable market is, generally EVs are higher cost. And so they make a lot more sense in the East Coast and in urban areas where you've got more wealth and more density. It's certainly going to be a dramatic grower in the marketplace. I just think the rate of growth is going to be questionable. And the profit margins, I think, are going to get tight. They already are tight. And I think that the ultimate winners to me are going to be guys who are doing both combustion and EV. And so how does that model, how do they get that right? How does GM, how does Ford, how does Audi, how does BMW get that right?
We're generally on that same page with you. This group of lube shops is in Western New York and Oklahoma. So you're preaching to the choir, Doug.
So what are you guys seeing next year for the M&A markets? What's your kind of crystal ball tell you? And by next year is 2025.
The same thing we've been saying for all of 2024, which is right around the corner. But I actually think it is. I think 25 is, on a relative basis, big year for M&A, constructive debt markets, constructive equity markets. And I don't know that I believe that on a fundamentals basis, but I believe it on like a technicals basis of I'm generally a believer interest rates are going down. There's a lot of momentum around the new administration that I think is going to carry us into 25 nicely.
I think 25 is going to be a lot more similar from an M&A perspective to 2024. It'll be up from 2024, but not in a massive floodgates opening sort of way. It'll be better, more volume, more transactions. Again, similar in terms of the feel of 2024.
I think it has to be better just because there's too much money at stake. The investment bankers need to be paid. The LPs need return of capital. The private equity firms have been investing heavily in growth. And so I think a lot of those legacy portfolio companies are now getting to the point where they can get that kind of magic 2 times their money. And so you're getting these companies that were maybe not at the sufficient threshold to sell getting to the point. But the ages of the portfolios are just too old. And the LPs, we've been talking about this all the time about DPI. The capital needs to be returned. The investment bankers need to get their bonuses. The LPs need to get capital returned if they're going to put more money in. There's just so much at stake that the engines and the wheels will be turning. And then when we look at the data behind what's coming in through the diligence phase, the other encouraging thing is we're seeing a lot more activity for diligence on companies in previously out of favor markets. So industrial, tech, healthcare services are all growing pretty meaningfully over like lows. I agree. I don't think this is going to be like 2021 but it's going to be pretty good and better than what has been otherwise pretty unspectacular kind of markets.
Agree with that.
So I think we've accomplished a lot there. Let's declare victory.
Very cool.
All right. Thanks, guys.
A special thanks to HCI Equity Partners, a lower middle market private equity firm focused on driving transformational growth through consolidation strategies by partnering with family and founder-owned manufacturing, services, and distribution companies. Learn more at hciequity.com. ICV Partners, an innovative lower middle market private equity firm supporting management teams of leading companies at the lower end of the middle market. Learn more about ICV at icvpartners.com. And finally, Blue Wave, the Business Builders Network, connecting the most proactive business builders in the world with the best service providers for critical, variable, on-point, and on-time due diligence and value creation needs. Learn more about Blue Wave at bluewave.net. For further information on HCI, ICV, and Blue Wave, and relevant topics discussed here in the episode, please see the episode notes for links.
The views and opinions expressed in this program are those of the individuals presenting and do not necessarily reflect the views or positions of any other persons or entities, including those referenced herein.